Hello and welcome to this video on monetary policy, focusing in particular on quantitative easing. So in this video, we're going to look at what is meant by quantitative easing, describe the process involved, and then look at some evaluation points. So quantitative easing is all about increasing the money supply, the amount of money in the economy. It's worth just considering first of all though, so what is money? Well, in theme 1, you would have looked at the functions of money. And often we think about money as just being notes and coins. But if you think about all your money, how much of it physically is in notes and coins? Actually, very little of it. A lot of it is in banks, stored digitally in savings accounts. So money is not just notes and coins, it's also the balance you have in your account. We might take it a bit further. If you have a credit card, now does a credit card, is that money? Well, it spends like money. You can use a credit card like money to buy stuff. It's not quite the same as notes and coins. It's money you've been kind of credited that you have to pay back in future. What about share certificates or shares? Would you say they're money? Possibly not. But again, you might be able to use them to buy something or to exchange. So there are different categories that we have when we're talking about money. We would define the money supply as the total amount of monetary assets available in an economy at a specific time. There are several ways to define money, but typically we would look at the amount of currency in circulation and deposits in financial institutions. So we would typically look at the number of notes and coins, but also the amount of money that's stored in banks and the amount of money that banks have issued. And if we look at how these two forms of money have increased over time, it's quite interesting to see that actually notes and coins make up a relatively small proportion of the total amount of money that there is in the economy. The most of it is stored digitally within banks and occurs because banks can take an initial deposit. They have to keep some of it in reserve, but then can loan out the rest. When that money is loaned out, often it ends up in another bank who have to keep a proportion of it but can loan it out again. So a lot of money has a way of growing through what we would call a fractional reserve banking system, which we don't particularly need to know about, but that's why we have more than just the notes and coins in existence. So we were looking here at quantitative easing. So quantitative easing is to do with increasing the money supply. It's sometimes called QE, and we're going to have a look at how it works. Now, part of the story involves what's known as government bonds. And a government bond is something that is issued by the government when they want to raise money. So let's say the government spend more, G is greater than T, they spend more than they receive in tax. And in order to do that, they need to borrow money. And they will borrow money from you and me, they will borrow money from businesses. And to do that, they will issue what's known as a government bond. Now, what might work something like this. They might want to borrow £1,000. So you lend them £1,000 and they issue with a bond, a document that says the government promised to pay you back your £1,000 over the next, let's say, 15 years plus a particular rate of interest. And these are considered very safe investments to make because the government can always use tax money or create more money to pay off the debt. So this is how quantitative easing works. The first step is that the Bank of England creates money and adds it to their own account. Now, the Bank of England are the only organization within the economy who can do this, who can just create out of complete thin air their own money. With this money, they then use that to buy government bonds from financial institutions like banks, insurance companies, and pension funds. So the Bank of England will say, we will give you cash, and in exchange, you, the normal banks or insurance companies, you will give us your government bonds, the promises from the governments to repay, and we will look after them. The idea is that by buying up the government bonds and giving the banks cash, the businesses, the banks will then lend that cash out to businesses and individuals within the economy. This will then increase the level of investment and increase the level of consumption. If banks, insurance companies, people like this are more enthusiastic about lending because they have this cash, then they should, in theory, lower the interest rate that they charge, so encouraging further borrowing and spending, so more money is spent and the economy is further boosted. So there's a kind of double effect here. First, the cash can be lent out, but secondly, because there is more lending, then people are more willing to offer lower interest rates. And so there is a secondary round of more lending and consumption investments. Finally, the idea is that when the economy has recovered, the Bank of England sell back the bonds, the government bonds that they've bought to the banks, and then destroy the cash that they've created. So in the long term, there is no extra cash that has entered the economy. So that's the theory. You might want to watch this section again or take good notes, but that is the idea of how it works. The Bank of England create money, use this money to buy government bonds off banks. The banks then lend the money they've received to people, which boosts consumption and investment. And then once the economy has recovered, the Bank of England would buy back or sell back the government bonds to the banks, take the cash off them, and then cancel it. If we were to illustrate what's happening here, we might imagine that the economy is stuck at a price level P1 below the inflation target, and the central bank have already tried cutting interest rates. There's been no increase in aggregate demand, so they try QE, quantitative easing, creating new money to encourage investment and consumption. And because consumption and investment go up, we would see an increase in AD and the price level rising back. So, quantitative easing, what do we know about it? Well, the Bank of England in the UK created £375 billion in order to try and stimulate the economy. It's good news for borrowers because it lowers interest rates and makes more borrowing opportunity, but potentially bad news for savers because it reduces interest rates. They started in March 2009 and they've done it in 3 batches. And the aim was to try and increase aggregate demand and avoid the risk of recession or deflation. As we said, they increased the money supply and the banking system encouraged banks to lend at cheaper interest rates. They don't do this by printing new money, they do it all electronically and then use that money they've created to buy government bonds. There's been doubts about whether this has been effective because following the recession and following the use of QE, economic growth rates were still quite low. Let's also look at quantitative easing or buying assets to increase the money supply from the Eurozone perspective. This chart here shows us what the ECB have bought over the last 10 years or so, what the types of assets that they've been buying to try and get cash into the banking system. So the European Central Bank Asset Purchases Program, they call it Asset Purchase Program rather than quantitative easing, but it's the same idea. The central bank in Europe has spent 2.3 trillion euros to date on buying bonds since 2011. It spends approximately 60 billion euros per month at the moment. This money enters the banking sector and is designed to stimulate consumption and investment through more borrowing. The main aim of this program is to increase AD and therefore raise the rate of inflation closer to the target of just below 2%. So in evaluation, what are some of the problems with quantitative easing? Well, often what we've seen is that banks may just keep the money that they receive for selling government bonds to boost their profits instead of lending. This is particularly relevant at a time of a financial crisis when one of the main reasons was poor profitability and losses made by banks. They were like, thank you very much for the money for the government bonds. We'll just keep that at the moment. Secondly, an increase in the money supply, an increase in the amount of money may cause inflation, which we looked at earlier in the year. And lastly, an increase in the money supply, there being more pounds around, for example, may weaken the value of the pound on currency markets, giving us less buying power when we try and buy imports and goods and services from abroad. We mentioned there one of the potential problems with increasing the money supply is that we get high levels of inflation. Now this example here in Zimbabwe is what can happen if the money supply really does increase quite significantly and get out of control. We're not anywhere near this stage yet with the advanced Western economies like the UK and the Eurozone, but as economists it does serve as a good example of if we keep increasing the money supply, creating more and more money and putting it into the economy, we can get rates of inflation that look like this. OMG. So in this video, we've looked at what is meant by quantitative easing, we've looked at the process involved, and we have evaluated QE. That's it. Thanks very much.